Scott, big story in the Journal today. You've done a lot of analysis. What has happened to companies from 2007 to now?
Well, as you said, they've got more revenue, they've gotten more profitable, they've gotten noticeably more productive. I mean, we thought this was it's been 4 years since the official beginning of the recession, which was at the end of 2007, and we just thought this was a good time to take a long view back at how the world is different for the companies in the S&P 500 than it was before the recession started. And what we found was that they've got their revenues higher than it was in 2007, their profits are higher than they were in 2007, and even higher than their revenue increased over that time. Employment is back above where it was in 2007, but it's not as high as either revenue or profits, which suggests that they're getting more out of each worker, both from a revenue point of view and profit. Of course, the other thing that's up way up is cash. Companies very much scarred by financial.
We seem to be having a few technical difficulties there with Scott. We'll get him back in a second. But Neil, it's very interesting to see where we are with corporations after this devastating recession and how they've recovered.
Scott's articles, it's really remarkable how far back these largest companies have come. And the big questions that are raised in the article, I think, is, one, why aren't they hiring more? Why don't they have the confidence going forward because they have rebuilt these businesses since the financial crisis? And the second question is, what comes next with all these big cash reserves that they have? When are they going to invest in capital improvements? When are they going to build new factories? When are they going to replenish their IT and their computers and all that
Scott,
kind of
what
thing?
are they going to do with all that cash?
They're going to hold on to it for the time being. I mean, they're beginning to spend it slowly. We found that capital expenditures rose almost 20% among these companies last year, which was, more than the increase was bigger than it was in 2010. So there's some signs of them increasing. The thing they seem most reluctant to do is hire people, or at least hire people in the United States. And so of all the metrics we looked at, the one that's rising the slowest is total number of employees. There's a line in the story about a pharmaceutical company has a factory in Florida that in 2007 they pumped out 1 billion pills and capsules with about 800 workers, and last year they pumped out 2.5 billion capsules with about 900 workers. So, huge gains in output and productivity from not many more people.
And Scott, that's a fascinating point because, people often talk about the uncertainty about healthcare costs, about pension costs as reasons that American employers don't want to hire more, or they want to see real evidence of increased consumer demand. But some part of the story is, as you say, a technology story, an increased productivity story. And I think that's true in American manufacturing, too. Even as manufacturing comes back, it's not necessarily going to mean lots and lots of hiring.
Yeah, that's right. And so, on a per employee basis, for the companies we looked at, 4 years, over the 4 years, they increased the amount of revenue they're generating from each employee by 11%. It went from about $378,000 per employee in 2007 to about $420,000 per employee last year. And profits per employee were up even more than that. They were up about 17%. So clearly the trend is to get more out of each person. Some of these jobs as they come back are going overseas. And there are two reasons for that. One is cost, and the other is to be closer to markets. I mean, U.S. companies are selling, the big U.S. companies are making half or more of their sales outside the U.S. these days. And so some of the impetus to move manufacturing, move people, is to be closer to their customers.